The Australian dollar was surprisingly strong this week, rising above 72.80 to a new one-month high. This was despite no real change in expectations for the US Federal Reserve. Markets continue to price more than a 70% chance of the Fed hiking rates in December. And the US two-year yield has risen to 0.93%, the highest since early 2010. Commodity prices also haven't supported the Aussie dollar this week. Copper prices have fallen to their lowest level since 2009, and spot iron ore fell below $44 a tonne this week. That's a new low in the daily series which began in 2008. So iron ore prices are now at their lowest since the early 2000s. The record lows are around about $14 back in 1998. But obviously the downtrend that we've seen recently is a negative for the Australian dollar. There's also bad news for the Australian dollar in the third quarter capital expenditure survey. This showed a record fall of about 9% in expenditure in the third quarter. It's caused our economists to revise downwards their GDP estimate for Wednesday from 0.9% over the quarter to 0.7%. That's just 2.1% year over year. Admittedly, there was a little bit of optimism in the survey of investment intentions for 2015-16, but again, that's still down year over year. So where's the good news for the Australian dollar? Well, we've been focusing on an unusually large amount of activity in the mergers and acquisitions area where foreign investors have been buying Australian assets. Obviously, the focus this week was on the largest of those deals, Transgrid of New South Wales. This is the main electricity operator, and the auction produced a larger than expected $10.3 billion bid. A lot of the consortium that won are foreign investors, so there should be some demand for the Aussie in this deal and also a range of other deals. That looks to be a positive for the Aussie dollar, regardless of the negatives from commodity prices. Australia has a busy calendar in the week ahead, with the highlights being the GDP data on Wednesday and the Reserve Bank meeting on Tuesday. There isn't a lot of tension around the RBA's decision, with rates looking to be firmly on hold. Indeed, market pricing remains only at about a 1 in 3 chance of a rate cut by February 2016, despite the weakness in the CapEx survey. The main global focus will be on the European Central Bank, which meets on Thursday. At their last meeting, they effectively promised to deliver further easing measures on Thursday, but there is a great deal of debate over just what they might do. One way or the other, they should expand their monetary easing stance, which includes effectively printing money to buy bonds. That's likely to weaken the euro further. Euro weakness could be one of the supportive factors for the Aussie dollar going forward. And indeed, the Aussie against the euro is at its highest level since July. The US calendar is also busy, with the main focus being testimony by Fed Chair Yellen ahead of the Friday, November payrolls report. Overall, we expect these to reinforce expectations for a Fed rate hike in December and more in 2016, being reasonably supportive for the US dollar. This should be one factor that helps keep a lid on the Aussie dollar in ranges mostly about 71 to 73 cents. At a stretch, if there's a bounce in the Aussie after the European Central Bank meeting, we could get to about 73.80. But we still see the risks into year end being downwards for the Aussie towards about 70 cents. We'll speak to you next week.